All right, guys. So we got our new mic set up. Let me know how this sounds. I don't know how good my mic is going to be right now. So we got it set up. We got a new mic stand up, and everything should be okay. But like I said, let me know what the sound is like. Let me know if the volume is good. Let me know if we're running okay. And yeah, we'll see how this affects the market, guys. Let's take a look at what we got going on right now. Move this down away. Put some other charts up here. Market is mostly dropping right now. Looks pretty weak. We might trade a little bit ahead of this. You can see the market is roughly down. Here's the SPY in the middle. We got Tesla on the right. We got Amazon on the left. We're still holding Amazon. We might scale into a little bit more on that, depending on what everything looks like. Still pretty green on Amazon today, believe it or not. Looking like a short market as well. Taking a little small position here. We'll see how this goes. All right, we'll see if the market can flush down. I see Amazon dropping down. We'll get some music playing also. Let me know how you think this will affect the market, really. All right, let's get the music rolling here. Again, market's starting to break down a little bit, which is fine. I'm okay. I'll welcome that. All right, so we just cut that last little trade that we got out of. Trying to get the music rolling. How's the music? Can you hear it? How's the sound? All okay? Good. What's up, DS? What's up, Moose? What's up, Kyle, Jody, Step? We got this Jerome Powell press conference in less than an hour. So, bull or bear? Let's do some polls here. That's what we always do with these. Get some polls going on. Already got 130 something people here. Bullish or bearish on today's Jerome Powell speech, guys? Bull or bear? Vote on that poll. What do you guys think? Watching Tesla, watching Amazon pretty close to lows. Hey, what's up? It's at 1:30 Eastern Standard Time. Short when you see JP's face, huh? Hey. Good luck. Looking at the poll here, we did do a poll already. 42 votes already, 62% are bearish. Just made a little bit more, made another $30 today. Starting to get some rhythm in. You can see the Dixie here. We'll put the Dixie up. There's Tesla on the right. We can put the Dixie up instead. Here's the DXY. We're up about $100 today on Top Step. Dixie moving up, SPY moving down. Yeah, well, I got you. I'll put the timer up. Hold on 1 second, guys. All right, get the timer up. We'll get the scroller at the bottom so everybody knows what time it starts. All right, so it starts at 1:30. Right now it is 12:40 market time. So we got about 50 minutes until the actual meeting starts. We'll make it 49 minutes. Get ready to set this. And yeah, y'all be ready. Market's kind of consolidating around the lows here. Amazon's testing lows. All right, so we got the timer rolling here. Let's exit out all this stuff and get the timer up so you guys can see when the actual meeting starts. We're going to be streaming the full meeting live right here as we always do. Speech starts in 48 minutes, guys. You can see the timer right there at the bottom. See the SPY starting to move up a little bit. We're starting to bounce up some. Here's the dollar index here, which really ideally we'd like to see this drop. We have the Amazon's chart on the left here as well. But you can see the SPY is just kind of consolidating here. We kind of have back and forth movement where we're moving down and up and down and up. Kind of choppiness. We got this little sideways range right there that you can see. And again, we'll see if we actually break past that range. We're right now kind of recently starting to move back up some here, as you can see as well. So all I'm going to say, guys, is look at the screen. We got a timer that shows exactly when it starts. Okay. We got a timer that shows exactly when it starts. All right. All right, so we're starting to get a little bit of a rebound here. You see there's a little pop back up. You can see Amazon bouncing back up as well. You can see the dollar index falling down some here as well with it. So, yeah, we'll see if we get anything good here. What do you expect? Bear bull? I really don't know. I think this is a little bit more calculated. I don't know if it's more or less calculated, but I think this is a little bit less literal and more where the Fed might try to say some positive things. And so I'm bullish, but nobody really knows. But I guess I'm bullish if I had to pick a direction. We're at $46 right now, $46 on the spot, or 46 minutes until we start. So about 45 minutes. And again, that goes on the heels of today where we had, let me make sure I'm in this room and then nothing else has started yet. So we got 45 minutes. Let me look at the poll here. So far on the polls, we got about 164 votes in about 5 minutes. 51% are bearish, 49% are bullish. All right, guys, we're still gonna bounce it up a little bit here. All right, guys. So again, market's popping up a little bit. All right, there's one of the trades. All right, guys. So we're at 394s on the spot. Thank you, Caitlin. I appreciate the sub. Thank you very much. We appreciate it. So we're in the right ratio there.
Okay. We're going.
All right.
We'll be back in a little bit, okay?
All right.
Love you.
Love you. All right, guys. So yeah, so market's popping up. We're at 394s. Let me put the music back on. Bear with me, team. Hold on one second. Make sure the stream's going well. Stocks will fly after the speech. I hope so, man. Again, I'm an optimist. I want the market to do well. I don't want the market to do poorly or anything. You know what I mean? Like I want the market to fly up. Again, everybody wants to bet the market's going to go down, but for me personally, I'd like to see the market do well. You know, it's not like I want the market to fail. You get a lot of people that want the market to fail, though. Believe it or not. My trading's been pretty solid. I made money today for the most part here. All right, so 394 is here. We still got the meeting that starts pretty soon. All right, so market's mostly sideways. I mean, we do have somewhat of a bearish day. It's not like the day is good or anything like that, but It's also not the worst reaction. I mean, we did have GDP drop this morning. So like we did have GDP drop this morning. And it came in higher than expected, which means that like the Fed's job isn't quite done yet. At the same time, though, it doesn't mean that like we're not showing anything in terms of. It doesn't mean that we're not getting any damage done to inflation. The last few CPI reports were better than expected. PPI was better than expected. And so we're seeing a lot of optimistic signs regarding the economy, and I want the market to do well. It's not like I want the market to fail. So like with that, y'all just be safe. We don't know what we're going to get here. Market's still kind of testing up. We have that 200 EMA and the volume weighted average price moving up. So like hopefully that'll be a good favorable sign, but we'll have to wait and see. Hey, thank you, Bulls Target, for the sub. I appreciate it. Y'all don't forget to hit the sub button, guys. Hit the notification bell. We appreciate you all. We got over 300 people here. Yeah. Midnight Fever Disco. Again, vote on the poll. Let us know what you guys think. Looking at the poll numbers right now, about 300 votes, 54% are bearish on this Fed meeting. 54% are bearish. And yeah, I don't know what I am. I'm not really going to pick. I'm cautiously optimistic, as I always am, about these numbers. I'm kind of shorting the market right now on a day trade, but like, we still got some time. See if the market can keep tapping these lows. And so again, we'll see what happens. We had GDP release today. Tomorrow we still have PCE deflator tomorrow, which is a lot of time what the Fed uses to determine some decisions here in terms of rates. They also use PPI, they use CPI, PCE. Like I said, they use GDP to a certain extent. So hopefully we get some good stuff. But again, you can kind of see the leading up to this. The meeting starts in about 35, 40 minutes. We're pretty neutral right now. We're pretty choppy. I mean, you can see the market kind of going like this. So we're actually pretty sideways. I mean, we're not really doing anything major in the market. We're moving pretty neutrally over the last 5-10 minutes. Now, it doesn't mean like a lot of people are probably just patiently waiting for this to come out so they can figure out which direction they want to trade. Yeah, but this week we have tomorrow. We've got Brazilian GDP, we got challenger job cuts, we got global PMI for Brazil, we got jobless claims numbers, PCE deflator, we got personal spending numbers, real personal consumption numbers, personal income numbers. We have manufacturing PMI for November, construction spending tomorrow. So just a lot of we do have a lot of stuff happening tomorrow as well. Sometimes when we get these big data releases, the market's just slow and nervous, I guess is the best way to put it. Indecisive is probably another way to put it. Just because, depending on what we show for these numbers is going to impact people's positions. And so they're just less likely to take big positions. A lot of the time we get lower volume days leading up, to these releases here. So just got to kind of sit back and wait for the numbers to come out. And, we'll see what Jerome Powell says. Hopefully they say something positive. Most of the time people are betting that negativity is going to happen, and we'll see. We did a poll this morning on Twitter. Hey, thank you, Sar. Hey, thank you, bro. Jerome Powell speaks at 1:30. Calls or puts. Am I spelling Jerome Powell's name right? I guess so. Did a thing earlier. Let me see what we said earlier. Hit the like button. Do me a favor. Hit the like button if you haven't already. We appreciate it. We're voting calls or puts on Twitter if you want to join us here too. All right, so market's mostly consolidating right now, team. We're not really doing much. Check the chat. I'm betting my life savings on your words today. I don't want people to copy me. I have no idea what's going to happen. I might be wildly wrong about anything I say. I have no idea what I'm talking about, and do not copy me. Not liable for your losses. Don't sue me. Not an investment professional. Not financial advice. Any other way to put that? If you guys know a better way to put that, let me know. Don't sue me. Okay, I have no idea what I'm talking about. That's the best way. And with that, I have no idea what Jerome Powell is going to say either, bro. So do not copy me. All right, guys. Yeah, it's all good. Yeah, I'm just kind of trolling people as they troll me. It's all right. Hit the like button, guys. Listen, the OCD in me, I see 75 likes. And while I like 75 because it's a nice, quarter number, I'd rather 100, okay? Just humor me. Hit the like button, All right, market's starting to pull back a little bit, bro. I got this heater going. It is hot. You know what I figured out, bro? I actually only ordered 2 heaters. Yeah. Yeah, here you go. All right. You think you're smart until you have to spell guarantee. That thing always has my number, bro. That first little U in guarantee is like, Hey, thank you, Loris. I appreciate the sub, brother. Well, thank you, man. Welcome. Here we go. All right, there we go. We changed the disclaimer at the bottom of the screen now. Should be suitable. Yeah. I instead changed it to the bottom. I have no idea what I'm talking about. cannot guarantee any financial results or any trading results, and am not an investment professional. Is gold or silver a good buy right now? What do you guys think? Gold, silver? You guys buying gold or silver? Let me know. All right, market's been pretty sideways for the last, I don't know how long, man. Here's my timer. We got about 29 minutes left. Market's been pretty sideways since for the last 18 minutes. Market's been almost purely sideways, like complete sideways range here. So everybody's scared of Jerome Powell. There's the sideways range. Forgive my drawing terribly. There's the sideways range. Silver. Hey, thank you, Aku. Thank you. I appreciate you guys. Thank you so much. See what the market does with Papa Powell speaking. Amazon rip it up. I am holding Amazon. I'm holding Disney too. I haven't even looked at Disney here. Let's see what Disney's doing. There's the dollar index on the right. Okay. Hey, bought Disney this morning. Down like 25 bucks. That's okay. Acceptable. All right, guys. 30 minutes. 30 minutes. Music's a tad loud, not gonna lie. Okay. There you go. Is that better? Good. Market's incredibly sideways. Disney's trying to move up. Let's look at the Dixie. Here's the dollar index. I don't know about what Jerome Powell has in terms of holdings. No idea. Gold the best buy or sell. Let me send our newsletter out. Also, guys, join our newsletter. Hundreds and hundreds of people on our newsletter. And so if you haven't already, guys, join our newsletter. It's completely free. It doesn't cost anything. We got hundreds of people a part of it. Doesn't cost a thing. Just like my love doesn't cost a thing here, guys. Hit the subscribe button, okay? You know you want to. Let me see. If you want to join our newsletter, I'll put this link up. Check it out. Great way to help support the channel here. Completely free. If you don't join my newsletter, I'm going to cry like the music right now. Do it now. Good thing is that we're actually green on our short position now, so we will take that. Hey, thank you. It's Greg. Thank you, Greg. So the market is flying up all of a sudden here. Let's see what happens. See what happens. We'll see if the market pulls back some. We'll see if the we'll cut a little bit of it though. We'll see if the market ends up flying up or what happens from this. A lot of people think the market's actually going to fall. Will it? Let me know. All right, markets move it up. We're sending out our newsletter here. We're hitting the 200 EMA and the volume weighted average price now. Hey, thank you, Saul. I appreciate the sub. Thank you, sir. Sending out the newsletter now. Thank you guys so much. We got 500 something people here already. I need a TV. You're ready for a drop? Buy before the speech? I'm definitely not buying. I think there's risks in doing that. Shorting Dogecoin? Yeah, if you want to know what time the speech is, there's the timer. We got 24 minutes, guys. 24 minutes. 23 something now. Again, we will stream the whole thing. What's up, Omar? Quite bullish on. Hey, what's up, Lysolette? Thank you for the subscribe. Thank you so much. I appreciate it. Look, you hear everybody subscribing, guys. I mean, I'm not going to say you should do it, but you should. Okay. Well, we just cut our short position and got squeezed out, and that's all right. We're pretty break even on the day. Luckily, we were pretty green heading into it. But the market's just another choppy day. And that's all right. Eventually, we'll stop being choppy. As long as we can end days break even instead of losing, I think I'll take that as a W. Do you love me? Of course, bro. I love everybody, man. Except for Grom right here. I love everybody. You know. Yeah. I guess that's true, Maria. You know, the sun always has my number during every single afternoon / evening stream. The sun's just bearing down on me. You know, like I said, I'm like Edward in Twilight. Every freaking afternoon stream, it's like, boom, there it is. I need to get like some type of umbrella in here. You know, I need to get one of those big umbrellas and just put it in my office. You know, I could stream from like a tent or something. But do you love me exclusively? No, of course not. I don't love anybody exclusively, okay? Except for my dog, Rosie. All right, guys, market started to test highs. Again, we're pretty neutral right now. We're at 394.60s. The Dixie's mostly moving up today. The good news is that we're holding Amazon and we're green. We're holding Disney and we're green. Tell us more about this thing called the sun. Y'all hear little baby Bruce? Problem with Bruce is he never stops barking, man. He just barks and barks and barks. He's never quiet. He's always just angry and barking. You know, outside he barks, inside he barks. Hey, thank you. Thank you, Arg. Sorry if I mispronounced your name. SPY's still moving up, but that's good. Even though I was wrong about my short position, I'd still rather see the SPY move up today. You know, at least the market's green. You know? Bro. I'm going to have to throw Bruce outside, let my neighbors deal with him. All right, guys. SPY testing the 200 moving average, 200 EMA exponential moving average, as well as the volume weighted average price as we speak. Here's the SPY. Bro. He just barked on the beat. Mixtape coming soon. Dogs bark. There's a Terminator nearby. I mean, plausible. We got 20 minutes, guys. 20 minutes. 19 minutes and 43 seconds. Amazon. You see Amazon right here. It's starting to bounce back a little bit. It's almost up to 92s here. We got the SPY at 394.80s. We got the Dixie at 107s here, roughly. Bruce is good luck. Don't remove him. Okay, got you. Should I stand my desk up here? Maybe it's meant to be standing right now. And that way, like, if a Terminator comes, like, I'm safe because I'm standing up, you know? All right, guys. So, yeah, choppy market, sideways neutral market. The Dixie's actually been somewhat green today, but there's not a big inverse correlation here, it looks like. Like the Dixie flew up today, but the SPY didn't really drop that heavily here. We also had GDP growth, which is not really what the market wants right now. Again, you know, the whole point the Fed raises rates aggressively is to curb spending and inflation, you know. And so with that, when we see GDP growth, it's not really a positive sign. And we have dropped some since the GDP release, as well as we had the non-farm release today, whatever it was. It wasn't the actual non-farm. It was some type of preliminary non-farm results or something like that. It was non-farm something. With that, we also had JOLTS job openings. And so we've been somewhat neutral today, even though we've had some bad data come out, like data that wasn't good, you know, data indicating that the economy is not slowing down like the Fed might want it to, you know, which means that the Fed hasn't had the most control over inflation, and that's a pretty rough sign. Still, at the same time, though, you know, they are expecting a 50 basis point rate hike, which does indicate that inflationary problems are starting to subside at least a little bit. Hey, thank you, Freebird. Thank you. But we're definitely not out the woods yet. You know, we did have lower CPI, lower PPI. Other countries, European CPI dropped this morning. Hey, thank you, Options. European CPI did drop this morning, and that does indicate some good inflation, you know, curbing, but we'll see if that actually is enough to whoa people. Hey, what's up, Aku? What's up, Rolando? Yeah, I'm going to turn this off so I don't get all these notifications. It's not that I don't like seeing you guys subscribe. I mean, we're just, you know. I'm going to put it in sub-only mode as well. Wait, what have I done? What have I changed here? Okay. Yeah, so I don't know what I did here, but I'm going to just exit out of that and leave. There we go. Yeah, so markets started to move back up a little bit. We're going to put it in sub-only mode since we can. And help us get to 100K. We're getting close. We're getting close. We're almost at 93,000. It's pretty solid, I think. All right, so market's still pumping up. You can see the previous closing price. This level right here, this light blue line is the level at which we go from red to green, green to red on the day. You can see that light blue line right here. That's a terrible arrow. Let me fix that arrow. Disgraced by that arrow. Right here. Better. So you see this light blue line right here. This is the level at which the market goes red to green, green to red. So we're technically red. As we're underneath this level, we are technically red on the day in the SPY. Above this level, you can see we're kind of starting to move up here. If we break above this level like this and then hold support and then continue, then that's going to be a green day. And so we'll see if we can actually go green on the day. We're consolidating. You can see that we have the 200 EMA and the volume weighted average price kind of sitting right there around those spots. And so those are kind of milestone indicators. Like 200 EMA is a longer term indicator. So if we can get over that, as well as the volume weighted average price, sentiment might be swinging to the upside. We'll see what happens. Again, a lot of people short Jerome Powell speeches and stuff like that. And so we'll see if that's what we get. But yeah, who knows? Bull or bear, guys? Let me look at the poll here. We've got about 1,000 votes in the poll in about 30 minutes. 48% think bull, 52% think bear. So what do you guys think? Let's see if we can break back over 395. I think 395 is a good psychological level also. Amazon at 92s. Let me get this speech up. All right, so this JP, man, he's getting old. Honestly, JP's got a tough job. He's like that hard grandfather that just like, you know, never gives you an allowance, always makes you work for it. You know what I mean? 14 minutes, guys, 14 minutes. And so this is going to be Fed Reserve Chair Jerome Powell, the economic outlook and labor market. He's going to be talking about inflation, labor market, economic outlook, moderated by David Wessel, Director, Hutchins Center on Fiscal and Monetary Policy at Brookings. Yeah, it'll be interesting. We'll see how this impacts markets. Again, everybody's kind of waiting to trade. A lot of the time ahead of these, we're going to get neutral action, and that's kind of what we got today. Now, we'll see what happens. Looking at our Twitter poll, we did do a Twitter poll. We got about, we're pretty split. Okay. All right, guys. So we're at 395s right now. 395s. All right, 395 is big. Again, meeting hasn't started yet. We're just kind of waiting here. What do you guys think he's going to say during this? I guess is the question. I feel like Powell will be super hawkish. Don't know if the market will react. Do you want a decade of stagflation or crash and recovery? Powell doesn't want that decade. He will grind us to maybe. I know one thing, I would not want to be in Powell's position. Yes, it's a hard job, man. That's a job nobody wants. Everybody said I would take that job in a second. Somebody comes up to me and they're like, John, you know, you're the third best trader in the world. I mean, you're the natural choice for the next Federal Reserve Commissioner. Will you take this job? I'd be like, sure. Everybody would hate me, you know. I'd be aggressively raising rates fast and then just ripping the Band-Aid off, but, you know. Typically, Papa Powell hawkish. He's going to go, yeah, that's why a lot of people short these meetings. I trust me, I stream all these major economic meetings from Powell, and, like, the sentiment is overwhelmingly bearish every time I do one. To the point where it's like, if we go up, people get really mad, you know. Surprising. All right, so we're still kind of sitting here, guys. We got about 11 minutes. We got over 1,000 people here. Again, hit the subscribe button. If you haven't already, hit the notification bell. We do this live every weekday. We stream 120K buying power. Really, we got about 140,000 in buying power right now on Thinkorswim. We trade the futures market as well, E-mini, micro E-mini. We day trade short every weekday morning. We swing trade, we invest. We're pretty accurate with our swing trades. If you haven't already, we do this live every weekday morning for free. So hit the subscribe button. Do you think it'll be 50 or 75? Well, I guess 50 now. Yeah, I guess 50, but I really don't know. As anybody else, nobody really knows. Most likely 50, I guess. 75 is a pretty solid chance of that too. Depends on what happens. It's a weird month next month where we have CPI, and then the very next day we have the rate hike decision, and so we're going to get a little bit of understanding into what inflation looks like, and then the very next day we're going to have the rate hike decision. It's going to be a pretty volatile, couple days in my opinion. Will be fun. On the 13th, CPI comes out in December, and then on the 14th, the Fed raises rates. So, like I said, we'll see. Again, I'm staying kind of cautiously optimistic with all of it, though. I really don't know what we're going to do or anything like that. Dude, why isn't this downloading? Like, you can see here, like if we zoom in on this and we put our timer back up so people know when the actual meeting is, it's in 8 minutes and 23 seconds. We're kind of consolidating right around the 200 EMA. Hey, thank you, Jenna. I appreciate you. I appreciate you. Thank you very much. I bet he doesn't say anything important at all, and market basically ends flat. Well, it's not really a scheduled meeting in terms of like they're not actually releasing anything. It's basically pure sentiment from him, and I think because of that, because it's a little bit more calculated as opposed to actually being a data dump. I could see him saying some optimistic things, but again, I'm not 100% sure. Nobody knows. It depends on what he wants, I guess. But like I said, it's not a rate hike decision or any type of data release, and so with that, I would hope he'd say positive things and push the market up. All right, guys. So again, we're at 395s right now, 395s. So you see the Dixie up to 107s. 107s. We got about 6 minutes. And again, if you want to trade these big economic releases, one of our sponsors is a company called Top Step. Top Step, the base package is like 130 something a month. What you get with that is they give you a demo. If you can hit the target on the demo and follow the rest of their rules and conditions, then they fund you $50,000 with a 90% profit split. It's the most legitimate funded account program in the world. There's no PDT in futures, and you can trade the S&P 500 in the futures market with no PDT restrictions. Some paper trading accounts cost $100, and so for 130 something, you can basically get that with some pressure to succeed, but not the full extent. It's going to be a lot easier to try the futures market out that way. You're going to have more pressure than just a basic paper account, but you're not going to be risking thousands like you would if you put up 10K yourself in futures. And futures can go against you incredibly quickly. Again, they pay out millions, fund thousands of traders a year. They are a sponsor of my video. If you want to check them out, it's called Top Steps Funded Account Program in the futures market. Great way to get around the PDT rule. There's no PDT restrictions in futures. If you want to check them out, here is the link. You can also find it in the description. Only way to end the endless bull cognitive dissonance is for Powell to say you better hide. Yeah, maybe, bro. Yeah, this is the Brookings Institute. Max pay tomorrow is $3.99. I don't know. Will the US 500 be affected? Probably. How many times he speaks? Market pumps? Not often. Yeah, it's not an actual Fed meeting. Like I said, it's not an actual data release. I'm sure he doesn't want the market to go up, so it would be as hawkish as he can. Maybe. I mean, it's a balancing act here. It's hard. It's a balancing act. You raise rates too much, market crashes. You don't raise rates enough, long-term inflation problems. So it's a balancing act. It's a tough job. You do something right, everybody reward everybody. Nobody gives you credit. You do market goes down, everybody blames you. It's a hard job. 4 minutes, guys. 4 minutes. Let me get this ready. We should be up for this. Let me make sure. Yeah, we're here. All right. All right, so I'm not going to be able to put, we can probably put this up and then maybe like we'll leave the chart up. So I can put up the SPY here. Put up one screen maybe. I have to mute myself so Bruce doesn't hurt the stream. We'll put one chart up. We'll put the SPY up. You can also put the S&P. Just put the basic S&P up here if you want. I know how I can do it. I can do it like this. And then we put the dollar index at the bottom. All right, so there's the Dixie on the bottom. That should work. There we go. That works perfectly. Okay. Again, guys, we got a minute and 56 seconds left. Really, we got like 2.5 minutes, but like I made it a little bit early. Also, remember, hit that subscribe button, guys. I would never pressure you to, but if you don't, I'll ban you forever, okay? Do it now. How could you say no to this voice? Jerome Powell speaks in about a minute left, guys. We got about a minute left. We're almost at 93,000 subscribers today, so. Now we're pretty close with our timer. All right, guys, we got about 45 seconds left. 45 seconds. Be careful, guys. Again, not an investment professional. We don't know what he's going to say, what he's going to do. Y'all just be careful. That's all I'm saying. All right, guys, let's do this. Let's see what he says. All right, here we go. Look at that, man. Look how accurate that was, bro. Look at that.
Co-chair of the Brookings Board.
Sound check.
And on behalf of our president and some of my fellow trustees who are here in the audience today, it's my great pleasure to welcome all of you, both our post-pandemic in-person audience here, packed house, great to see, as well as our sizable broadcast and online audience. Thank you for joining us today. When President Obama named Jay Powell to the Federal Reserve Board as governor in 2012. No one, including I suspect Jay, expected him to become Fed chair. When President
Why is
Trump
the market
named
moving up?
Jay Powell as the Federal Reserve Chairman in 2018, hardly anyone anticipated a global pandemic. And don't forget that then the Fed's challenge was too little, not too much inflation. So Jay Powell has repeatedly been forced to confront the unexpected and had to steer the United States economy through uncharted waters. He's done it with a steady hand, great personal integrity, independence, and an unwavering commitment to the Fed's dual mandate, price stability, and maximum sustainable employment, though I don't think I need to explain any of you that today, despite stiff headwinds, both economic and political. So we're pleased to welcome to the stage today, on behalf of the Brookings Institution and the Hutchins Center on Fiscal and Monetary Policy, Jay Powell. Following his remarks, Mr. Powell will field questions from David Wessel, the director of Hutchins Center, and from the audience. Jay, thank you for joining us.
Thank you, Glenn. It's great to be here today. It's great to be back at Brookings. So today I'm going to offer a progress report on the FOMC's efforts to restore price stability to the U.S. economy for the benefit of the American people. And that report must begin by acknowledging the reality that inflation remains far too high. My colleagues and I are acutely aware that high inflation is imposing significant hardship, straining budgets, and shrinking what paychecks will buy. This is especially painful for those least able to meet the higher costs of essentials like food, housing, and transportation. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. We currently estimate that 12-month PCE inflation through October ran at 6.0%. While the October inflation data received so far showed a welcome surprise to the downside, these are a single month's data, which followed upside surprises over the previous 2 months. As Figure 1 makes clear, down months in the data have often been followed by renewed increases. It will take substantially more evidence to give comfort that inflation is actually declining, and by any standard, inflation remains far too high. For purposes of this discussion, I'll focus my comments on core PCE inflation, which omits the food and energy inflation components, which have been lower recently, but can be quite volatile.
Interesting.
Our inflation goal is for total inflation, of course, as food and energy prices matter a great deal for household budgets. But core inflation often gives a more accurate indicator of where overall inflation is heading. 12-month core PCE inflation stands at 5.0% in our October estimate, approximately where it stood last December when policy tightening was in its early stages. Over 2022, core inflation rose a few tenths above 5%, and it fell a few tenths below, but mainly it moved sideways. So when will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain. For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments, but for now, I'll simply say that we have more ground to cover. We're tightening the stance of policy in order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth. Last year, the ongoing reopening of the economy boosted real GDP growth to a very strong 5.7%. This year, GDP was roughly flat through the first 3 quarters, and indicators point to modest growth this quarter, which seems likely to bring the year in with very modest growth overall. Several factors contributed to this slowing growth, including the waning effects of reopening and of pandemic fiscal support, the global implications of Russia's war against Ukraine, and our policy actions, which tightened financial conditions and are affecting economic activity, particularly in interest-sensitive sectors such as housing. So we can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace for a sustained period. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into 3 component categories: core goods inflation, housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex-housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn. Early in the pandemic, goods prices began rising rapidly as abnormally strong demand was met by pandemic-hampered supply. Reports from businesses and many indicators suggest that supply chain issues are now easing. Both fuel and non-fuel import prices have fallen in recent months, and indicators of prices paid by manufacturers have moved down. While 12-month core goods inflation remains elevated at 4.6%, it has fallen nearly 3 percentage points from earlier this year. It is far too early to declare goods inflation vanquished, but if current trends continue, goods prices should begin to exert downward pressure on overall inflation in coming months. Housing services inflation measures the rise in the price of all rents and the rise in the rental equivalent cost of owner-occupied housing. Unlike goods inflation, housing services inflation has continued to rise and now stands at 7.1% over the past 12 months. Housing inflation tends to lag other prices around inflation turning points, however, because of the slow rate at which the stock of rental leases turns over. The market rate on new leases is a timelier indicator of where overall housing will go over the next year or so. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. As Figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. And this is likely to continue well into next year. But as long as new lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year. Indeed, a decline in this kind of inflation underlies most forecasts of declining inflation. Finally, we come to core services other than housing, and this spending category covers a wide range of services, from healthcare and education to haircuts and hospitality. This is the largest of our 3 categories, constituting more than half the core PCE index. Thus, this may be the most important category for understanding the future evolution of core inflation. Because wages make up the largest cost in delivering these services, the labor market holds the key to understanding inflation in this category. In the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. Thus, another condition we're looking for is the restoration of balance between supply and demand in the labor market. Signs of elevated labor market tightness emerged suddenly in mid-2021. The unemployment rate at the time was much higher than the 3.5% that had prevailed without major signs of tightness before the pandemic. Employment was still millions below its level on the eve of the pandemic. Looking back, we can see that a significant and persistent labor supply shortfall opened up during the pandemic, a shortfall that appears unlikely to fully close anytime soon. Comparing the current labor force with the Congressional Budget Office's pre-pandemic forecast of labor force growth reveals a current labor force shortfall of roughly 3.5 million people. This shortfall reflects both lower than expected population growth and a lower labor force participation rate. Participation dropped sharply at the onset of the pandemic because of many factors, including sickness, caregiving, and fear of infection. Many forecasters expected that participation would move back up fairly quickly as the pandemic faded. And for workers in their prime working years, it mostly has. Overall participation, however, remains well below pre-pandemic trends. Some of the participation gap reflects workers who are still out of the labor force because they're sick with COVID-19 or continue to suffer lingering symptoms from previous COVID infections or long COVID. But recent research by Fed economists finds that the participation gap is now mostly due to excess retirements, that is, retirements in excess of what would have been expected from population aging alone. These excess retirements might now account for more than 2 million of the 3.5 million person shortfall in the labor force. What explains these excess retirements? So health issues have surely played a role, as COVID has posed a particularly large threat to the lives and health of the elderly. In addition, many older workers lost their jobs in the early stages of the pandemic when layoffs were historically high. The cost of finding new employment may have appeared particularly large for these workers, given pandemic-related disruptions to the work environment and health concerns. Also, gains in the stock market and rising house prices in the first 2 years of the pandemic contributed to an increase in wealth that likely facilitated early retirement for some people. The data so far do not suggest that excess retirements are likely to unwind because of retirees returning to the labor force. Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees. So, the second factor contributing to the labor supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers. Policies to support labor supply are not the domain of the Fed. Our tools work principally on demand. And without advocating any particular policy, however, I will say that policy to support labor force participation could, over time, bring benefits to the workers who join the labor force and support overall economic growth. Such policies would take time to implement and have their effects. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market. Currently, the unemployment rate is at 3.7%, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. So far, we've seen only tentative signs of a moderation in labor demand. With slower GDP growth this year, job gains have stepped down from more than 450,000 per month over the first 7 months of the year to about 290,000 per month over the past 3 months. But this job growth remains far in excess of the pace needed to accommodate population growth over time, about 100,000 per month by many estimates. Job openings have now fallen by about 1.5 million this year, but remain higher than at any time before the pandemic. Wage growth, too, shows only tentative signs of returning to balance. Some measures of wage growth have ticked down recently, but the declines are very modest so far relative to earlier increases and still leave wage growth well above levels consistent with 2% inflation over time. To be clear, strong wage growth is a good thing, but for wage growth to be sustainable, it needs to be consistent with 2% inflation. So let's then sum up this review of economic conditions that we think we need to see to bring inflation down to 2%. Growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods price inflation appears to be easing as well, and this too must continue. Housing services inflation will probably keep rising well into next year, but if inflation on new leases continues to fall, we will likely see housing services inflation begin to fall later next year. Finally, the labor market, which is especially important for inflation in core services ex housing, again accounting for more than half of the category, shows only tentative signs of rebalancing, and wage growth remains well above levels that would be consistent with 2% inflation over time. So despite some promising developments, we have a long way to go in restoring price stability. Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done. Thank you.
Yeah, so he's doing a Q&A, correct? He's got to be,
Thank you very
right?
much, Chair
Yeah.
Powell. I think you spared me the chore of
Subscribe,
asking you
team.
to pick between 50 and 75, so I won't have to ask you that. Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable productivity. You said in November that wages are not the principal cause of prices going up. But for many workers, real wages have been falling lately. So I wonder, isn't there room for wages to rise a bit faster so workers can make up lost ground? And what level of wage increases do you think is consistent with a 2% inflation target?
Okay, so I guess I would start by saying that the inflation that we saw at the beginning of this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation has now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So we think it is an important thing going forward. And ultimately, in the service sector in particular, where wages and benefits are by far the largest cost, wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5 or 2% above that with current wage increases. So particularly the employment compensation index and the average hourly earnings index. Look at those two. It's about 1.5% higher than what would be consistent, making various adjustments, including for productivity from nominal wages. So, and as we look at the labor market today, including today's JOLTS data, what you see is a labor market that there's a real imbalance between supply and demand. There are 1.7 job openings for every unemployed worker, everyone looking for a job. The so-called jobs workers gap is about 4 million, meaning if you look at all of the available jobs, including people who are working, and then look at people who are in the labor force or looking for a job, there's a 4 million shortfall. So you're in that world, and we think that there's a job for moderating demand in there and getting the labor force back into balance.
You don't think that there's a possibility that we should have a period of catch-up of wage increases above the sustainable level, and that businesses with relatively fat profit margins can absorb some of that without passing it through?
So that's the question of the worker share of profits and that kind of thing is not really related to this. Right now, people's wages are being eaten up by inflation. So what you want to do is you want to have inflation stable and then have a very strong labor market where the biggest wage gains are going to the people at the bottom end of the spectrum. And we had that at the end of the very long expansion that ended with the pandemic. That's not what we have now. Now, for most workers, the increases they're getting in wages are being eaten up by inflation. That's actually not true at the bottom end, where wage increases are higher than inflation. And that's a good thing. But if you want to have sustainable, strong labor market where real wages are going up right across the wage spectrum, especially for people at the lower end, you got to have price stability. And until we restore that, we can't get back to that place where we kind of were for the 2 years before the pandemic hit.
And did you take, when you looked at today's JOLTS data, which measures the vacancies and quit rates, did you find that encouraging?
Yeah, they came in at
More or less in
127
line with expectations, but that's
It's going the right direction,
that's a
though.
good thing, right? So yeah, so I guess job openings came down by several 100,000 to where they are now, and yeah, that's a positive thing. As you know, the relationship between job openings and unemployment is a very fraught one, and job openings right now compared to unemployment are at their near their all-time high levels. So it has been our view that there's a possibility that in this highly unusual situation in the labor market could come back into balance to some extent through a decline in job openings, and that there's been a typical relationship between increasing unemployment and declining job openings, but that our thinking has been, and many labor economists share this, that you could get a decline in job openings that wouldn't produce the same increase in a smaller increase in unemployment than is typically the case looking back in history because of the very outsized level of job openings. And we've kind of seen that so far, but it's way too early to say that'll work.
Traditionally, the Fed looked at the unemployment rate as a measure of labor market tightness, and we've seen recently that may be misleading. Unemployment rate is still very low, and as you pointed out, job vacancies are starting to come down. But to the extent that the Fed still relies on a Phillips curve kind of relationship, going forward, is the natural rate of unemployment a useless concept? What measures will the Fed use to judge labor market slack as we look ahead to policy in the coming years?
So I think the way we think about it, of course, the standard way to think about it is it's the gap between the actual unemployment rate and the natural rate of unemployment that matters, right? And the issue really, it's not that framework doesn't make sense. It does make sense. But the issue is that the natural rate of unemployment is very hard to identify with certainty, even in normal calm times. But when there's a violent disruption of the labor market, it can move very substantially. So, and that happened at the beginning of the pandemic. You had the labor market was very much disrupted, and we assumed that the natural rate had moved up, meaning that for any level of unemployment, the labor market is tighter. So we knew that. And I think what was different in this cycle was really that you had to look at things like job openings and quits and reservation wages and just wages overall to tell you that the natural rate of unemployment had really moved up quite a lot. But I don't think it's a problem with the framework, but it is a fact, though, that it's very hard to pin down where the natural rate of unemployment might be when there's this massive disruption in the labor market going on.
So do you think that the JOLTS data, the job vacancies per unemployed worker, that's going to be a lasting measure of labor market tightness for you at the Fed?
Yes, I think people will tend to look at it.
Well, when you tell them you're looking at it, they tend to look at it.
They'll look at it.
I've noticed that.
That's right. I think I would just say in this particular situation, we think it's important, and we're going to find out empirically whether that was true for the reasons I explained. We think that we can see a big decline in job openings and less than you would expect of an increase in unemployment. So this was a unique in so many different ways.
Right.
This series of events was different from one in particular is just that so much of the inflation was due to supply side constraints,
Right.
which is not a feature of the U.S. economy for a long time.
Well, but Vice Chair Lael Brainerd said the other day in a speech that she raised the question of whether long-term changes of the economy, like labor supply, deglobalization, climate change, could make the could reduce the elasticity of supply, and that this may be a problem going forward. Do you share that?
So this is a great set of questions that we've all been thinking about a lot. And Lael's speech was really terrific on that. Augustine Carstens has given a couple of speeches on the same topic, including one at Jackson Hole this year.
The head of the Bank for International Settlements.
Yes, exactly. I mean, the question is, does the new normal going to be unlike this normal that we've had, where supply side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that. It'll sort itself out, a supply shock from oil prices or whatever. Are we going into a situation a little bit like the 70s, where there will be ongoing repeat shocks, and which would tend to put more upward pressure on inflation over time? We don't really know. I mean, it's a great question. But the question, I guess the real question is, if that's true, what are the implications? We still have a 2% inflation target, and we still have to use our tools to achieve it and to keep inflation expectations anchored. But it's very hard to know. It's very hard to know the answers to these things. I mean, we tend to assume things will go back to the way they were just naturally, but that doesn't seem to be happening so far.
Right. Now, you mentioned in your remarks that forecasts of inflation have, not only those at the Board of Governors, but in the private sector as well, have been lousy. Inflation has not behaved the way the forecaster said. So I wonder how you think about using forecasts of inflation and making policy. If you can't tell us, or if your staff can't tell you with some degree of confidence what inflation is going to be 6, 12, 18, 24 months out, how do you think about that in deciding when you make policy decisions?
So I'll say that it is very difficult to forecast inflation now, and one of the reasons is just that the situation is so different from the normal one. And as I mentioned, a lot of it is just that the difficulty is just these supply side constraints that we've had. We had no experience in forecasting that. It was, this was a case of first impression. So that was very difficult. Nonetheless, we do make forecasts. We'll continue to make forecasts. The way I tried to get around that in my remarks was to say, let's put the forecasts aside for a second, and let's try to identify the macroeconomic conditions that we think we need to see that would put downward pressure on inflation. So that's a way to think about it. We'll continue to make forecasts, but we're going to have to be humble and skeptical about forecasts, I think, for some time. And that calls for a lot of risk management. And the other difficulty, of course, is that monetary policy works with long and variable lags, and particular inflation is at the end of that train. And so if you're waiting for actual evidence that inflation is coming down, it's very difficult not to over tighten if that's all you're doing. So we have a risk management balance to strike, and we think that slowing down at this point is a good way to balance the risks of
slowing down on the pace of rate hikes.
That is why the market is going up.
But it's still a problem.
If you want to know why, that's why.
If you can't use today's inflation rate to set policy, and you're not sure what tomorrow's inflation rate is, you're saying the inflation forecast will be secondary to the economic conditions that you think are likely to generate more or less inflation. Is that basically?
Well, first of all, I'm agreeing that it's a very difficult situation in which to forecast inflation, and really very few professional forecasters have gotten it right. So I think we'll look at various things. We'll look at our forecasts. We'll look at the actual data. We'll look at, I gave you the three pieces and the elements of those three pieces of core inflation that we're looking at. We will, look at these macroeconomic conditions where, for example, we will try to identify a level of a stance of policy that's sufficiently restrictive to bring inflation down. We can't identify that with great precision and confidence, but we'll look at the changes in financial conditions and the effects that those financial condition changes are having on the real economy. We'll look at all of those things and make a judgment, and it'll have to be judgment as to what that is.
Well, when you think you've talked frequently about the need to have policy restrictive, and that often is used as the definition of restrictive is above some neutral rate of interest, the one that will prevail when all is calm. And you gave a speech at Jackson Hole a number of years ago pointing out how identifying all these things, the natural rate of unemployment, the natural rate of interest, the problem is that we don't know what they are. So how will you know when policy is restrictive? How do you think about what the neutral rate is under the current conditions of the economy?
The answer to that is that there isn't any one perfect summary statistic. So the way I think about it, and I think the way we generally think about it, is we make our policy changes and they affect financial conditions. Actually, it works the other way around. Financial conditions tighten in expectation now, different from what it used to be. So they tighten. And so we monitor the tightening of financial conditions. We look at the history of these financial conditions index and we ask how tight are financial conditions. We also look at the effect that tighter financial conditions are having on the real economy, particularly now interest sensitive spending, but also other things as conditions tighten. We also look, so what are the financial conditions we look at? We'll look at the entire rate curve. If you think about risk-free, the treasury rate curve, we'll look to see significantly positive real rates across the curve. And, you have that, you can argue about the short end, but you've got to pick some sort of a forward-looking reading for inflation. And I think, inflation compensation in the markets definitely reflects confidence in us bringing down inflation. So you've got real rates really across the whole yield curve. You also look, though, at credit spreads and what are private companies borrowing at, because most borrowing doesn't happen at the federal funds rate. It happens in many other places. We look at asset prices. We look at exchange rates, which are just another asset price. We look at all those things, and we try to make a judgment about whether put some weight on the real interest rate curve, some weight on the other aspects I talked about. I think you have to make a judgment at the end, though, that you're restrictive.
So an estimate of the neutral rate of interest didn't seem to be one of the big factors in that list you gave?
No, it's in there. It's in there in looking at the real rate curve. So you look at the real rate curve, you'd want real rates to be above what we'd estimate as the longer run neutral rate. The issue is, the longer run neutral rate is a rate at a time of full employment and 2% inflation and the economy in perfect equilibrium. That isn't where we are.
Yeah, I noticed. Can I turn to the balance sheet for a minute? I'm going to turn to questions from the audience in a minute. What criteria are you going to use to decide when to end the shrinking of the balance sheet? Is it the economy? Is it whether money markets are functioning well? Is it whether the Treasury is having trouble raising money? How do you decide when you've shrunk enough, when you should end the shrinking?
So I should refer you to a document that lays all this out in detail that I really should be reading to you, but I'll paraphrase it.
Thank you.
If I don't get it exactly right.
No one will pay attention if you don't get it exactly right. Don't worry about it.
Pretty much wing it.
Relax.
So we're in an ample reserves regime. And what that means is that changes in the reserve level will generally not affect the federal funds rate. So there's more than enough reserves in the system. So we're not close to reserve scarcity. So what we said is that we would allow reserves to decline until we're somewhat above the level that we think is consistent with an ample reserve, with scarcity.
Right.
And then for a while, what you do is you hold the balance sheet constant, and non-reserve liabilities grow while reserves shrink. So we sort of shrink gradually down to that. And then at a certain point, we're just going to call it. We're not looking to really go back into proving that they're scarce, because what happens is, and you saw this back a few years, the demand for reserves is not stable, and it can move up and down very substantially. So we want to stop at a place that's safe. Having a lot of reserves in the system is really a good thing. It's really a public benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system, in the financial system generally. So that's how we would do it.
In the minutes of the last FOMC meeting, it said the staff had a forecast that it forecasts below potential growth, but not a recession. But then there was this interesting sentence where the staff said the possibility that the economy would enter a recession sometime over the next year is almost as likely as their baseline forecast. Is that how you look at it?
So I have resisted the temptation to handicap it.
Go on.
I think I'll continue to do that. But I get the way I think about it is I do continue to believe that there's a path to a soft or a softish landing. I do believe that. And
the definition of a softish landing is what? Unemployment goes up a little, but we don't have a recession?
Yeah. Unemployment goes up, but it's not a hard landing. It's not a severe recession. You could think of unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it. And I think the path is pretty clear. It's the labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens but doesn't go into recession. And you see inflation start to come down. And I mean, I think that's very plausible. I don't want to be the handicapper on it. And of course, our job is to try to achieve that.
Mm-hmm.
And I think it's still achievable. Although, if you look at the history, it's not a likely outcome. But I would just say this is a different set of circumstances.
So you said at the last press conference that you thought the path to that soft landing had narrowed. Has it continued to narrow, or is it widened? Or I don't know if you can have a wider soft landing, but
I don't know that it's changed since this is what, 5-6 weeks ago. Yeah. I was asked the question, has it narrowed? Is it still possible? And has it narrowed? It's definitely still possible. And it has narrowed because if you look over the course of this year, nobody expected us to raise rates this much. No one expected inflation to be this strong and this persistent and this, to have spread so broadly through the economy. And so to the extent we need to keep rates higher or keep them higher longer, that's going to narrow the path to a soft landing. On the other hand, if we get good inflation data and we get evidence that all the things that I talked about, if all those things start to swing the other way, then we could very much achieve this.
In August 2020, you announced a new framework for monetary policy, the flexible average inflation targeting framework. And I wonder whether there's anything in that you think we should be rethinking now in light of the recent experience.
So we said we would do another framework review in 5 years. And so that would be to bear fruit in 25 or 26. So that's what we're going to do. We're going to stick to that. I think we need to see this through a full cycle. We need to see the other side of inflation and what the economy looks like after this historic episode to really make good judgments about that. I will say, though, that aside from the framework itself, we implemented it through guidance of various kinds. And we put in really strong guidance because there were a lot of doubters that we would ever achieve 2% inflation, if you remember. That was the main criticism. Little did we know. But one piece of guidance that we gave was, and I don't think this had anything to do with or much to do, let's say it that way. It didn't have much to do with all this inflation we're experiencing. But the one piece of guidance that we gave that I probably wouldn't do again is we said we wouldn't lift off until we saw both maximum employment and price stability. And I don't think I would do that again.
Because
I think it limited it's the tail risk. We tend as human beings to underestimate tail risk, and I think we didn't think. It seemed so unlikely. If you remember, 25 years of low inflation,
right,
and many years after the pandemic, after the global financial crisis of inflation everywhere in the world, it's all disinflation. Just didn't seem likely, and yet here we are.
So it turns out that when you invite the chairman of the Federal Reserve to speak at Brookings, a lot of people email you questions. Most of them are questions I've already asked, or questions that were so poorly framed that I couldn't even understand the question. But somebody asked me this one, and so I want to give that person an opportunity to get an answer. What do you like to do in the morning before you start work?
Work.
What a great question.
No,
Wow.
I'm a super early person, and I read a bunch of newspapers and drink my coffee in peace, and then that's what I do.
And now that you're chair, do you still ride your bike to the?
Some. I ride down. Well, I won't tell you where I ride, but I do.
Yeah.
I ride.
The security guys, thank you for that.
They're like, no.
Yeah. Okay, so here's the deal. We're going to take questions from the audience. You need to wait for a microphone to get to you because we have a lot of people online. You need to say who you are, and you need to remember that this is not an opportunity for you to make a speech or tell the Fed what it should do. It should be a question. It should be short, and questions end with a question mark. So
This will be fun.
Come down here. Why don't somebody, Joe, and then Jonathan.
Thank you. Joe Beaulieu from Brevin Howard. So you've spoken both about risk management considerations and the inherent danger of inflation becoming entrenched. So I was wondering, how much do risk management considerations suggest a terminal rate higher than would normally be expected to achieve your policy goals?
That dude should sing. That dude should
So I
sing.
think there are a number of dimensions, and it wouldn't necessarily, one of them would be potentially higher rate, but more, I would think, one risk management technique is to go slower, right? To go slower and feel your way a little bit to what we think is the right level. Another is to hold on longer at a high level, and not loosen policy too early. I don't want to over tighten. Certainly, my colleagues and I do not want to over tighten, because I think the cutting rates is not something we want to do soon. So that's why we're slowing down and going to try to find our way to what that right level is. But I mean, theoretically, it's another dimension, but it's not. It wouldn't be my first choice.
Thanks. Jonathan?
Hi, thanks. Yeah, Jonathan Pingle with UBS. So I had a question about the imbalance between labor supply and labor demand. One of the things that's a little obscured when we look at and discuss the labor force participation rate is there is a pronounced downward trend due to population aging. So when you think about realigning labor supply and labor demand, are FOMC officials hoping or expecting that participation really moved back up all the way to a pre-COVID peak? And related to that is, the follow-on question, how much of the realignment do you think needs to be done through restricting labor demand as opposed to the ability of supply to catch up?
So on labor force participation, I think it's useful to go back 10 years, and the forecast that mainstream labor economists had was that, and you're right, aging of the population leads to declining labor force participation. Notwithstanding that, labor force participation was in effect flat and a little bit up from 2013 to 2020, roughly. And that was because you had a strong, tight labor market. People were staying in the labor market longer than expected. That was really what it was. So our ability to predict is not perfect in this, except over long periods of time, you have an aging population, so you're probably going to have declining labor force participation. I don't think it's reasonable to expect that we get all the way back to where we were with labor force participation in 2020 at 63.7, I guess, population adjusted. I don't see that, but I wouldn't rule it out. And we're nowhere near that now. We're 1.5 points below that now. So the real question is, do we expect to see big chunks of labor force participation? I got to say, this year we've seen, in the aggregate, not much, and it's been very disappointing and a little bit surprising. So that's part of the story. The other part, as I mentioned, is population. Is that the labor force, a big part of the shortfall in the labor force is actually population as well as participation.
So given population trends, given that there's still some workers are clearly anxious about going to work during COVID, and given that immigration is well below the levels that were projected before the pandemic, does most of the balancing have to come on the demand side?
Well, I think for now, we have to assume that. That's why I talked about, supply side policies on labor, but although they're not for us to recommend or to answer questions about.
Noted, please.
So yeah, the answer is yeah. I mean, that's what I kind of said that in my speech. We have to do what it takes to restore balance in the labor market to get back to 2% inflation. And that's what we're doing. Really just by slowing job growth rather than putting people out of work.
Joe Gagnon.
Thank you. Joe Gagnon, Peterson Institute. Chair Powell, back in 2018, you gave a speech questioning the role of the so-called star variables that the Fed uses to navigate. And there was a possibility raised that maybe unemployment could fall well below what the staff thought the natural rate U star was, then without causing inflation. But then COVID came and turned everything around. And as you just said, one interpretation of COVID is that U star went way up and we were on the wrong side of it, which is inflationary. My question is, going forward, is it likely, do you think it's likely that things could reverse as the dust settles from COVID and we could end up back in that world where maybe we're on the other side of U star, we don't know it, it's hard to tell. What lessons did you learn from that period that got forgotten because of COVID, perhaps?
Well, unemployment went below so what we write down and what the staff writes down is a longer run longer run estimate of the natural rate of unemployment. I guess one thing I would say is that during the course of a long, relatively gradual, I mean, so we only have one experience, right, to generalize from, but what I learned from that experience was long, relatively slow, not super fast expansion. You really saw the natural rate of unemployment, the shorter term natural rate, come way down. We had 3.5% unemployment with really little sign. Wages were just getting up to that level of productivity and 2% inflation. So we could be back in that place. I think we could certainly be back in that place. But what we've seen, you know, it's another N=1 situation with the pandemic. It's also unique. I would also point out, though, we did see the inflation we saw at the beginning. We did have natural rate of unemployment go up probably significantly. But the original inflation we saw was not to do with the Phillips curve, with the labor Phillips curve. It was not to do with that. It was to do with goods more.
So I think another way to frame Joe's question is, I think a lot of us thought that the lesson we learned when unemployment fell very far and we didn't get inflation, that maybe over time, before you were in charge, the Fed was erred on the side of being too tight. It was too worried about the unemployment rate falling. And I think the concern is that, will we fight the last war? And because of this experience, the Fed will be reluctant to experiment with a low rate of unemployment in the future.
I'd love to have that problem again. If we can get back to, you know.
Okay, so you got like 3 years left in your term. Do you think you can pull this off in the next 3 years so we can run the N=2 experiment?
Absolutely. Yeah.
Claudia Sam?
Claudia Sam Consulting. So the question I had is, we've had unexpectedly fast and large rate increases this year, and that has pushed up the dollar relative to basically any currency in the world. We've seen likely more financial market instabilities. So the Federal Reserve's dual mandate is for the United States, and yet are you worried that a severe global recession or financial market turmoil would come back to make it harder for us to achieve the U.S. dual mandate? Thanks.
So we do, of course, look at global developments. We have a domestic mandate, of course, as every central bank does. But in this world, global financial markets and the global economy really matter for us. So we monitor all that very carefully. We really think, and my colleagues and I really think, that the best thing we can do for ourselves and for the global economy is to get inflation under control as quickly as possible. We don't think the world's going to be a better place if we take our time and inflation becomes entrenched and then we have to go in later. The evidence is that the employment costs of bringing inflation down only rise with delay. So at the same time, we don't want to do any more than we have to do, but we feel like as a risk management matter, we needed to do what we did and feel like we're now in a place, again, as I said, where we can slow down and try to reach that ultimate level.
But how much do you worry about, I think what Claudia's question implies is, we do something with rates, other people are forced to do things with rates, and that ends up spilling back to us and makes it harder for you to do it. So you have to take that possibility into consideration.
We absolutely believe that we take that into consideration. The model's explicitly taken into consideration. Of course, they're not perfect. No one would say we do it perfectly, but we have a very large global model that we use for the global economy, and it absolutely takes into account what's happening with the real economy and monetary tightening and currency and all those things. It won't be perfect, but we do that. And we also sort of understand generally that there's a lot of research and things, people are talking about this a lot right now, that, maybe the whole is bigger than the sum of the parts when it comes to tightening. Maybe it is, maybe it isn't, but we're aware of the risk of that. But again, I come back to, look where we are. We've raised, 375 basis points. Markets are working. I think we're now in a position where we're in a place where we really can get inflation under control, and unemployment's at 3.7%. So I don't regret getting to where we are, and I think broadly the world will be better off if we can get this over quickly.
Thanks. Julia? Julia, stand up so the mic can find you. And can you bring a mic down here for Feroli,
Can I ask two questions?
if they're short.
Yeah, very short. So one question on the labor market is how do you reconcile, the characterization of the labor market as very tight with the fact that wage growth isn't keeping up with inflation and the labor share of GDP really hasn't risen since 2020. And then second question is how much credence or what kind of research do you rely on to think about the notion that a very tight labor market will lead firms to invest in and innovate and become more productive over time? Could that be a tailwind to productivity growth?
Okay, I wrote those down really fast. Now is the problem with reading my handwriting. So you asked about
Well, the labor market is tight, but wages are not rising
real
faster
wages,
than
real wages.
inflation.
Okay.
And the labor share of GDP, which has been depressed for some time, hasn't really started to rise. So how do you put that into your thinking?
So naturally, we understand that real wages are not going up for most people. But to me, that isn't that's true, but it's not really dispositive. I think the issue really is that it's one of salience, really. So at what point do people start saying, I need higher wages because my real wages are going down. You're giving me these 6% wage increases, but inflation is 7.7%. I need more of that. So we don't really know when that point is. But when you get to that point, you're in serious trouble. And we don't think we're at that point, but it can't be that we can go on for 5 years at very high levels of inflation and that it doesn't work its way into the wage and price setting process pretty quickly. So that's a serious concern. So on the second question, yes, I think we're seeing that. You're seeing the service industries. You're going to see, this labor shortage that we have, as I mentioned, it doesn't look like it's going away anytime soon, and that's absolutely, I think, certain to lead to a lot of investment in technology and labor replacement technology where there isn't labor, and I think you'll see quite a bit of that, and could it be a dividend going down the road? I would think it'll have to be to provide the services that the public wants to buy.
Thanks, Mike Feroli, JP Morgan. So you spoke about going somewhat restrictive and then staying there for a long time. Why would you prefer that over a shock and awe approach that goes very restrictive but for a shorter period of time? And I ask that because there's some evidence that sacrifice ratios are lower in a more aggressive regime like that.
I think we've been pretty aggressive, I would say. No, I don't. I don't agree. I mean, we wouldn't, to just raise rates and try to crash the economy and then clean up afterward. I wouldn't take that approach at all. I think we're in a position where the right thing to do is to move really quickly as we have, and now slow down and get to that place where we think we need to be. And by the way, there's high uncertainty around that. We have a broad set of thoughts about where that destination might be, but we could be wrong. It can be higher than that, could even be lower than that. We'll have to see. But I think that's the right approach, and that's also the approach that it would allow us not to throw away the option value of upending a lot of lives, which we would do if we crash the economy and we might get rid of inflation, but at very high human cost.
There's a question in the very back, a woman in front of the camera. Do you want to stand up? Thanks.
Thank you so much for seeing me in the back here. Nancy Marshall-Genzer from Marketplace. Just wondering, Chair Powell, is the Fed in danger of neglecting its maximum employment mandate? Is the maximum employment mandate taking a back seat to the stable prices or inflation mandate?
No, absolutely not. Absolutely not. The thing is this: without stable prices, we can't have maximum employment, and that's how I think about it, and I think my colleagues as well. In the sense that if you're constantly fighting off inflation and having these battles and having to raise rates, and it goes on for 5 or 10 years as it can, you're not going to have maximum employment. The situation we would love is to have another one of these very long expansions, and we've had 4 of them now in the last several decades. Really, when inflation was low after the 70s, we got out of the habit of these short inflation-driven business cycles, and we were able to reach. You saw where we were 3.5% unemployment those are really good for, very beneficial to our society to have these long expansions, and the benefits start to go to people at the lower end of the spectrum in the 7th or 8th year in the last cycle. So I think the two things go together. Right now, the labor market is incredibly strong. Again, before this thing, we've never had 1.7 job openings for every unemployed person. So this is a great labor market in that sense. It's too great in a way because it's going to be adding to inflation.
Time for one more. In the back, the gentleman on the aisle. All right, 2 questions. 2 gentlemen on the aisle. Keep them short.
Thank you. I'm Orange Wang from South China Morning Post of Hong Kong. So I would just like to ask a question related with Chinese economy. So right now, a lot of analysts are arguing or believe that China's zero COVID policy is continuing to take a toll on the Chinese economy, but also likely to weigh on the global economy due to the size of China's market and its position in the global supply chain. So we're just wondering about what impact or how much impact do you accept that continuously slowing Chinese economy would have on the US economy or the Fed's next interest rate moves? And is China's current economic situation a disinflationary factor or a inflationary factor to the US? Thanks.
I guess I just say that to the extent China's having shutdowns in the parts of the country and the parts of the economy that are deeply connected to global supply chains, that's going to make those supply chains less efficient, less effective, and so that will have an effect on the prices of some of these goods that are manufactured or assembled in China. So it does have an implication for the U.S. It's hard to say how big that will be without knowing how persistent, how long these lockdowns take place for.
The gentleman behind you.
Thank you. Evgeny Shego with Public Citizen. I was wondering how you think about the trade-off of restrictive policy and the supply constraints you mentioned. So in particularly when it has negative effect, say on housing production that makes it harder to meet housing demand, or on the congressional investment through the Inflation Reduction Act in climate change mitigation and in energy policy that will make energy cheaper long-term. How do you think about that trade-off?
Yeah, I don't think our restrictive policy would have much of an effect on the sort of climate mitigation investments you're talking about. In terms of housing, there are 2 things. One, there's sort of a longer run housing shortage that we have, but in the meantime, we had coming out of the pandemic, rates were very low. People wanted to buy houses. They wanted to get out of the cities and buy houses in the suburbs because of COVID, and so you really had a housing bubble. You had housing prices going up at very unsustainable levels and overheating and that kind of thing. So now the housing market's going to go through the other side of that and hopefully come out in a better place between supply and demand. But none of this really affects the longer run issue, which is that we've got a built up country and it's hard to get zoning, it's hard to get housing built in sufficient quantities to meet the public's demand.
So I want to thank you, Chair Powell, for being generous with your time, and thank you all for coming in. I want to appreciate everybody asked a short question, which that's the first time in my experience in 8 years in Brookings that's happened. I'd like it for all of you to stay in your seats for a minute till the chairman can leave safely. And if you have paper, coffee cups or something, take them to the back of the room and dispose. So thank you very much.
All right, guys. So interesting here. Interesting. So yeah, that was the meeting here. Now, again, I said this just now. What I think here, this is what I truly think, is that I think that Jerome Powell, I think he doesn't want to crash under his watch, guys. He doesn't want the market to crash under his watch. And so even though like a really aggressive rate hike kind of ripping the Band-Aid off, in my opinion, might be more effective, I think he's going with prolonged rate hikes, but not super aggressive that are going to cause a crash, because I don't think he wants a crash under his term. And I think that makes the most sense. And it's arguable which one's going to be the most effective here. I know bears are really upset. I see them in the chat. A lot of emotions floating around, and I get it. I really do understand. But it's arguable, and he's not going to want to crash under his watch. What he said makes sense, which is that he'd prefer a prolonged they're still aggressive, but they're not going to be as aggressive as like to cause a crash, so to speak, which is what a soft landing is. Now, again, we'll see if they accomplish that. We'll see if this is the right decision over time. All we can really do is speculate at this point in time. But yeah, it'll be interesting to see kind of what happens here. And again, let me know what you guys think. Also, guys, don't forget to subscribe. I mean, we're pretty close to 93,000 subscribers. We are pushing towards, we are pushing towards, 100K pretty soon. So we're pushing towards that right now. Hey, thank you, Sim. All right, guys. So yeah, so give me 1 second, and then hold on 1 second. Let me see. I think I got the music playing a little bit too loud here for this. There we go. All right, guys. Let me see if this works. Bear with me here, team. Trying to check on one thing, and then also, guys, y'all check out Top Step. Top Step is a funded account program for futures, and so if you want to trade these big economic releases, like you see me kind of day trading these releases. I made a bunch on Disney. I made a bunch of it on Amazon. But one of the ways you could day trade this without needing like a $40,000 account, like I have, is in the futures market. There's no PDT in futures. You could day trade short in the futures market, and Top Step is the most legitimate futures funded account program in the world. They give you a demo. If you can hit the target on the demo while following the rest of their rules and conditions, and they fund you between 50 up to over 150,000. You can find out more info on the site. You can get 20% off if you use my link. Check it out. There's the link. Also, guys, check out Chart Prime. Chart Prime is a trading view indicator service. What they ultimately do is, let me make sure. So Chart Prime is a trading view indicator service. What they ultimately do is they offer these premium indicators on TradingView. And on TradingView, you can use it in stocks, crypto, Forex, futures, whatever you want to use it in. It's incredibly useful. If you look at this here, right? If we look at this, I can put up any chart. I can put up the SPY, Tesla, the E-mini, whatever I want to do, right? I can pull this up. It's a premium indicator service. The real edge, in my opinion, it automatically documents supported resistance. There's so many different options. Again, the real edge is when you get two different ones show up. Like I like looking for this predictive algorithm as well as this bearish engulfing candle. Any two that show up at the same time, there's going to be a high edge in that. I can't guarantee you're going to make money. They are a sponsor of my video, but look at this. These two showed up at the same time. We get a nice drop. Bullish engulfing and possible reversal. We get a nice bounce. Recently, these two showed up. We got the oscillator showing up here with possible reversal up, and we get a nice bounce. Possible reversal down, we get a drop. And so it's actually surprisingly accurate. I know I look like John Madden here, but again, if you want to check out Chart Prime, really, really useful indicator service. At the very least, it's going to just show you what the candlestick patterns are, right? So bearish engulfing candles, bullish engulfing candles are some of my favorite momentum strategies. And they have a ridiculous sale giving you 40% off right now in Chart Prime. So 40% off sale going on right now. If you want to check them out, I will post this link here so you can check them out as well. They do have a sale. And yeah, really interesting company. I will put the promo code up here. Hold on 1 second. I will put the banner up if you want to check that out. Let me put this up. Hold on 1 second. Yeah, so we put the banner up here so you can check it out. I also put the link in the description. Check it out. Here is the link for them. And then we also, like I said, guys, today we have a video detailing. It's just a quick little short. If you want 20% off of Chart Prime, check out this link. But yeah, you can get 40% off at other places. There's the link right there. And again, if you want to check it out, you can see the banner right here. It's called Chart Prime. They got 40% off on their holiday sale. Really useful. Again, I can use it in stocks, crypto, Forex, all that good stuff. But yeah, you can see the market. Huge rip today, man. Who knew we would be at 403s right now? That's crazy, crazy numbers, man. 403s. The market absolutely skyrocketed up, which is just crazy, man. Honestly, just huge market momentum. We'll see if the market moves up. Do you think the market's going to move up tomorrow is the real question. Will the market move up tomorrow? Chat, what do you guys think? Will the market move up tomorrow? Yeah, I made a little bit of money on Disney, Amazon, Yeah, so we also have the PCE deflator, which you even heard JP says that they review for their Fed rate hike decision. All right, guys. Yeah, so let me put this up here. There we go. I think that should be good. We got that up. And then we just have to put this up. Just said what we thought he would say. Yeah, I mean, all right. All right, guys. Let me make sure we got this done. I think we should be good with this. Got to be careful with these shorts to make sure they're actually working. All right, yeah, that should work. All right. So let me export this. Make sure we're logged in here. Make sure we're going to YouTube. Yeah, so basically what he said, and again, I think one of the reasons we could be optimistic here is because he said, like, okay, a lot of people think they're going to continue to raise rates aggressively. Like with that, it's one of those things where, okay, I know people want them to raise rates more, and I know bears desperately want the market to go down, and I understand that. But one thing I've been saying here is that we're seeing some optimistic signs. Uh, uh, we're seeing some optimistic signs. Okay, I think that's good. Uh, I hope we get honestly some better action moving forward. But again, so we're seeing some optimistic sides. If you look at the last CPI, it was less than expected. Now it might be conventionally high, but it was less than expected. If we look at the last CPI, if we look at the last PPI, it was less than expected. If we look at the GDP was a little bit higher than expected, so that's a negative sign. But we are seeing some prices. Again, I said it before, I'll say it again. Prices are definitely better now than they were in the summer. Like summer, we had really rough pricing. And so in that regard, it's kind of one of those things where, we're seeing better prices now than we did. We're just seeing better prices now than we did. Now, I don't know if we're going to continue to get better prices. I know bears obviously are pretty upset about it or whatever it is. But, in the end, we're seeing cheaper prices. We're getting a little bit better prices. And I hope it's something where, I hope it's something where we get some type of good favorable activity here. I hope we get some type of favorable action in the stock market. I never want to see the market go down, and I get what people are saying in terms of like they need to be more aggressive if we actually want to see some damage to the market. I really do understand that. Like I truly do understand that. But I think we're seeing some optimistic signs, and I think what Jerome and at the same time, it's like I said, if I'm being objective, Jerome Powell doesn't want to crash under his watch, man. He does not want to crash under his watch. He would, regardless of what's the more effective choice, I think he would probably rather prolong somewhat aggressive rate hikes over a longer period of time than just kind of ripping the band-aid off and going super aggressive short term, causing a crash and then cleaning up afterwards. What he said in that regard made sense. And I think that's what's causing these big optimistic responses, because it does signal lesser rate hikes moving forward into the future. And now, of course, the bears are going to say, oh, well, what about prices? Prices are still high. Absolutely, prices are still high. They're still very conventionally high, 100%. Can't argue with that. But it's an optimistic side. And I think prices are better now, which means that the rate hikes that we've been doing so far are starting to do some damage. Hopefully it continues. I'm the type of person that I don't want to see the market do bad. I don't want to see the market do poorly. I would prefer the market to go up if we had a option. I'm a big bull, to be honest, in the market. I don't want to see the market crash. And I think it's very difficult to predict a crash as a whole. You know, I think most people try to predict crashes. Every year I've seen people say the market's going to crash, the market's going to crash, and then it does it. And then the same people that are telling you the market's going to crash get really upset when the market does it, you know. And then the next year you can look at what keywords are even trending, you know, 2020 market crash, 21 market crash, 22 market crash, and it never really crashes. Everybody wants to be Michael Burry. Nobody is, and except Michael Burry. And I know he's pretty short right now too. So we'll see, you know, but again, I want to see the market go up. I made a bunch of money on Disney and Amazon. Regardless of whether it's sensical or not, I can't really complain. You know, so let me know how you guys are doing this week. Let me know how you guys are doing this week. And yeah, hopefully we get something good. We also, like I said, y'all check out Top Step. John, we just wanted to drop for 5 minutes. That's it. Hey, listen, y'all make y'all's money, bro. Make y'all's money, dude. Again, I'm not really bad. I don't really have a bias. I mean, I want the market to go up. People asked me before. I said, hey, look, I think we might be doing some damage to these rate hikes. I hope that does. And I hope that's good. And I hope we continue moving up, you know. All right, guys. So we got our video premiering here. Let me put the redirect thing. So we're going to be redirecting to a quick little short, kind of recapping my Top Step progress here. And so again, if you want to check it out, I'll post this link. Great way to help support the channel is just check it out. Wait, let me refresh this. All right, let me make sure this is working. We got the instant premiere going on for our thing going on right now. So let me make sure this is working. All right, we refreshed. It should show up here now. Bro, where is it? Let me save this. Yeah, we got 13 people watching. Hey, that's good. All right, let me find this. Where to go? There we go. Let me exit out of this first. But yeah, market's still pumping up. We're still almost to we're still almost to 403 again, man. That's crazy. That's good. I hope we continue there. Bro, where'd it go, dude? Why isn't it showing up? Is it public? It is public. Whatever. So I got this premiere going on. Y'all want to watch the short? Here's the short. I guess they don't let me redirect it here. Here's the short if you guys want to check it out. And also, y'all check out Top Step. Top Step is a funded account program for futures. They give you a demo. You can hit the target on the demo while following their rules. They fund you between 50 up to 150,000. Greatest, easiest way to get around the PDT rule. You can check out the link in the description. I'm trying to get this router thing to work. For whatever reason, let me log in. Maybe I got to log in here. But yeah, guys, with that said, though, I'm going to close it down pretty soon if I can't get this to work. But yeah, it should be interesting here. We had pretty fun views. We'll be back tomorrow morning. Again, tomorrow they do have PCE deflator dropping, and that'll be really, really relevant for everything going on right now. So it's something that you probably want to be paying attention to in markets. It's something that you should be watching here in markets. So just be ready. We'll see if we get anything good. And yeah, I guess this isn't working here. So I'm going to close this. Watch the next video I got going. I'm trying to redirect. Let me do it this way here, I guess. We'll try to redirect this way, see if it shows up there. Okay, so yeah, so whatever. This thing is just weird. It's not showing up. Okay. All right, guys. I'm going to end the stream. Love you all. I'll see you guys later.